Let's talk about diversification. A lot of people think that diversification means just buy as many stocks or ETFs as you can so that it helps reduce risk. But that is actually a really poor investing strategy, as it could lead to a very underperforming portfolio. So before you go and buy every single ETF you see out there, make sure you follow these strategies when it comes to diversifying your portfolio. Welcome to ETF Friday. I show you how to build a solid investment portfolio with just ETFs. First type of diversification you want to look at is diversifying by asset class. When you're diversifying by asset class, you want to look for three things. One, something that will give you growth. So these types of investments are called equities. With equities, you're taking on a little bit of risk in order to see substantial returns of your investment. Second thing to look for is capital preservation. So with these types of investments, whatever money you put in, it is almost guaranteed that you will get that capital back. But with these types of investments, you will not see any significant returns. You will get anywhere from 3 to 5% returns. These types of investments are called fixed income. Another thing you want to look for is hedging. So this is when you're hedging against either inflation or an economic downturn. You're protecting your cash in an alternative investment class. So things like gold, silver, and these types of investments are called commodities. Now, when you are diversifying by asset class, it's very important for you to assign percentages to these different asset classes based on the amount of risk that you can stomach. The second type of diversification is by country. So you want to make sure that you are geographically diversified. You can't just put all of your money in the US market or put all of your money in the Canadian market. You want to be diversified because each of these different countries have their own economic climate, and sometimes each economy is not always going to do great. But when you're diversified across multiple geographic regions, no matter what is happening in any part of the world, you always be making money. And the third type of diversification is by industry. Different industries perform differently. With some industries, you will see a higher rate of return because those industries are high booming industries. And then some industries are slow growth industries, but those industries are very dependable, especially in times of economic downturns or recession. These are called recession proof industries. So you always want to pair those growth companies with a little bit of those defensive or recession proof companies because, again, we've seen multiple times the economy is not always going to be great. So when you pair those high growth companies like tech stocks with some of those recession proof companies, it allows your portfolio to stay balanced. And no matter what's happening in the economy, your portfolio will continue to stay profitable. If you want me to audit your portfolio, just comment audit and I will tell you exactly what you should be keeping in your portfolio, what to get rid of, and if your portfolio is optimized for growth. Make sure you hit that follow button and come back next Friday for more.